Okay, let's combine these two indicators and see how basically we can use them to enter into the market or to determine a buy position for spot traders. So now, this indicator called the Bollinger Bands and the MACD, moving average convergence divergence indicator. These are powerful indicators that you can learn and use to make your trade entries. I did a separate video explaining each. I did a video explaining the Bollinger Bands, what they are and what they represent in the market. Then a video explaining the MACD, moving average convergence divergence indicator, what it is and what it represents in the marketplace. So now go watch those videos. They are there on my profile. So now the Bollinger Band, to do a little recap, it has 3 lines. This is the lower band, which is a 2 standard deviation from the middle band. And the middle band is a 20 moving average. Then the upper band is a 2 standard deviation from the middle band. The Bollinger Band has different behaviors. Its main aim is to show you the volatility in the market, how volatile the market is. Like for example, during periods of low volatility, the Bollinger Bands will shrink. They will shrink or they will contract like you see here. They are moving in a tight lace. They are shrinking or contracting. But during periods of high volatility, the Bollinger Bands expand. They expand to show you that this period, we have entered a period of high volatility. So you determine when you want to trade, during periods of low volatility or high volatility. But remember, when there is low volatility, we expect high volatility to come in. When there is high volatility, we expect low volatility to come in. It is a vice versa. So they show you how volatile this asset is, how volatile the market is. The Bollinger Bands can also act as a dynamic support and resistance in this case, whereby when it approaches the lower band, it is expected to be supported. The price is expected to be supported and move up. So as a trader, as a spot trader, you would love to enter into the market when the price action approaches the lower band. When it approaches the upper band, it is expected to be resisted and the price will move back, is expected to move back to the middle band. So we have said that it forms a shrink or it contracts to show that this area is an area of low volatility. Then it forms a bubble to show that this area is an area of high volatility. Another thing, it can show you where the market is expected to be supported and where the market is expected to be resisted. Another thing to look at is the moving average convergence divergence indicator. It has the signal line and the MACD line. The MACD line is a 26 or a 12 moving average. Then the signal line is always a 9 moving average. It has the histograms, which is the red histograms and the green histograms. When the bars are strong, when the histogram bars are strong, it shows period of high volatility. And when they start shrinking, it shows that either sellers are losing momentum. If it is for the green candles, buyers are losing momentum in this period. So when there is a strong selling pressure, the bars will be huge. Also, these histograms can represent the distance between the signal line and the MACD line. So when the MACD or the signal line bridges that gap between them, it means that a particular trend is losing momentum. So after understanding how the MACD and the Bollinger Bands work, let's first see when do we make our entries into the market. What you have to do first is to look for volume. Like for example, remember the MACD is a lagging indicator, which means that by the time the crossover happens, the market may have moved. Like for example, we see in this case, the market has already been moving up by the time this crossover has come to happen. So, one, you look for a free bar. It is a free bar that forms below the Bollinger Band. That free bar is a great trading signal for you to buy. It shows you that this market is going to move up. After looking for that free bar, in the case of a Bollinger Band, after looking at that free bar that is forming below the lower band, that is the first confirmation that you need to enter into this market. Then after, you look for a crossover, or you anticipate a crossover that, accordingly to me, these histograms are losing momentum, which means that sellers are losing it. They are losing momentum. A crossover is about to happen. After predicting a perfect crossover which is about to happen, you enter into the market. The Bollinger Band is a lagging indicator. It shows you the direction of the market, but it is a bit late. It doesn't move with the market. The Bollinger Bands move with the market. It moves with the direction of the market. So, I told you, we identify a free bar. After this free bar forming, it is a great signal that this market will go up. Then we anticipate a crossover. We anticipate that these red histograms are losing momentum. They are losing it. You enter, you take your trade at a current price here. Let me say, if it is on that candle, you take your entry. After taking your entry, you lied. You take your take profit in on anticipation that a crossover will happen, like in this case. So, using your ROI2, take a 5% or a 2% according to your risk appetite or waiting potential. This is how you enter the market using the Bollinger Bands. What you have to do, and I emphasize, you wait for the this free bar to form here. And when it forms, that is a great signal that this market will go up or will move up. Then after the free bar forming, you come, look at these histograms. Are they losing momentum? When they're losing momentum, that is a great signal that this trend is losing its power, and this is my time to enter into the market. You take your entry and you prepare to take your exit. Though in this case the volume is not that great and the market has not showed that it will go up with a great momentum, but when we are doing an analysis to the market and you find a crossover on the positive side, like for example here, we have identified our free bar here. It has formed. After forming, we have identified our crossover, and the crossover is on the positive side. You ride your wave. You take your profit. You can identify that. With screen time and practice, you will learn the things. You will learn how to do the analysis. Get yourself like 2 to 3 indicators. Stick to learning those indicators. You will learn how to enter into the market and get out of the market with profits. So, for this case, that is how you enter the market. Whenever, even if a free bar has not formed, but a free bar is a great signal that the move will be great or the buyers will be strong. But when you identify that the price is approaching the lower band and the crossover is happening, please take your entry and prepare to take your exit on the next line or on the upper band. So I believe you have got something out of this training today. Consider subscribing, like this video so that we can reach more people with this simple explanation. Thank you for watching.